Oh, thank goodness that the Fed cut rates 0.5%. The markets are soaring. I mean, gosh, it's so great that the Fed stepped in and saved us from a recession, because clearly we're not going to have a recession anymore. I mean, the Fed's in control, right? They dropped rates, the market soared. Wait a second, hold on. 2007. This article is not even 2024. This is from 2007. Deja vu. What am I thinking? Like, this article's not even current times, but it is exactly the same day, exactly the same situation, and exactly the same rate cut in 2007, and the market soared until, drum roll please, they didn't. And we entered the Great Recession. But here we are, 2024, and so many people think that can't happen again. No way. But yet the Fed played the same game, the same rate cut to the exact same amount in an effort to make you think that we're gonna be fine. And the markets, well, they didn't soar. That's what we're gonna cover today. Are the markets gonna soar? Is everything gonna be okay? Are we gonna soft land this pig, or is this sucker going down like the Titanic? These are the things we're gonna cover. We're gonna hit the markets, we're gonna hit Bitcoin, we're gonna hit real estate, and we're gonna talk about the impact of this rate cut and future rate cuts and what they're gonna mean for your money, your family, and your financial future. My name's Chris Naugle. This is What Now? What's next for the Fed's rate cuts? So let's unpack this. Is there gonna be a recession? Is the rate cut gonna be enough to make it so the markets just keep going up? Is everything gonna be perfectly fine and wrap it all up in an election year? Well, let's dive in. So the best way to really understand what is going on is just to look back in history. Just like I showed you a second ago, that article that I got all excited about. Well, I wasn't excited, but from 2007, where the Fed in September of 2007 dropped rates 0.5%. On the exact same day, the Fed dropped rates 0.5% in 2024. Anyone seeing the parallel there? Same day, same rate cut, same scenario. But the one thing we can tell is in 2007, we know that the outcome was the Great Recession. That rate cut did absolutely nothing, but the market did soar when the Fed pulled rates. So here's an interesting thing to look at. We're in an election year, a very controversial election. I've talked about this a lot. You got Trump and Kamala, you got them both running for the presidency in a close race. So doesn't it just make sense that the Fed tries to prop the markets up? And the markets are sitting at all-time highs. Matter of fact, when the Fed dropped rates, the markets didn't skyrocket. No. They actually already had built in the rate cut. That's how efficient the markets are. They build things in. You see, the markets already knew the Fed was gonna cut rates. They just didn't know how much. Was it gonna be 0.25% or 0.5%? But the Fed went with the larger 0.5% cut. Well, the markets did rally, but not when that happened. The markets needed time to digest. Is this good? Is this bad? This happened in 2007, and that led to the Great Recession. Here we are. We got a weakening job market. So let's just talk about some of the things happening today. Jobs are weakening. The economy clearly is weakening. The cost of goods and services are up over 20%, in some cases double what they were just a few short years ago. So it costs more money to live. Are people making that much more money? The answer is no. The cost of goods and services went up faster than the wage increases. So now, what does that mean? Well, just look around. That means debt is skyrocketing. I've also covered this. Credit card debts, historic highs. And defaults, not so much defaults, but delinquencies. See, there's a difference between delinquencies and defaults. Delinquencies are up 40% on credit cards. But don't stop there, because then there's car loans. Yeah, delinquencies are way up. I don't have the exact percentage, but way up on car loans. And then you got the student loan thing, which, hey, is my student loan getting paid off by Biden or is it not? Oh, no, it is. Nope, it's not. Supreme Court has blocked that. So therefore, your student loans are not being paid off just yet, or maybe never, or maybe someday, or we just don't know. So let's just kind of talk about the current state of affairs. It's an election year. You got high debts. You got delinquencies on the rise. You got unemployment numbers ticking up. You got jobless claims going up. You got all sorts of things hinting that the economy is going down, but yet the Fed drops rates 0.5%, which does a couple things. Number one, it will make money cheaper. Should say make money cheap again. Yeah, it'll make money cheaper once again. You see, the Fed tightened heavily and rose interest rates trying to get a hold of the inflation, which did drive to over 9%. And now inflation's sitting at right around 2.5% if you actually believe what they post. But let's just say it's 2.5. The Fed's target was 2, so we're not quite there. But hey, in an election year, there's a little bit of pressure on Mr. Powell and the Fed to drop rates to make everybody happy. Who are we trying to make happy? The crying little baby. And who's the crying little baby? Wall Street. Wall Street's the crying little baby that never shuts up. It's kind of like Boss Baby. Ever watch that movie? Yeah, remember in the beginning? He was the boss. And when he didn't get what he wanted, he cried until he got what he wanted. That's Wall Street. Just watch Boss Baby and you'll understand how this is going to play out. But anyway, let's get into some of the more specifics. The Fed cut rates 0.5%. So what does that mean? Well, it means that mortgage rates have come down, which means that opens up a whole bunch of new buyers that now become eligible to buy a home. But hold on a second. Are there actually homes for that person to buy? Yes, maybe now they're eligible because 0.5% reduction in rates brings the mortgage rates down to a level where now all of a sudden they are qualified to get a mortgage based on their debt to income ratio. So now they go out and they start looking for housing, but there isn't all that much housing. And the housing that there is available is really expensive. So most of the first-time home buyers can't afford the housing stock, so we got a little conundrum. Well, if the Fed drops rates again in September, like Powell opened the door for, that would be a 1% decrease, hypothetically, in 2024, in the election year. They potentially could drop rates 1 full percentage. Now, all of a sudden, you do open up a whole bunch of new buyers for real estate. And people that have been hanging on to their houses because they can't move and get a decent rate, they might start saying, well, you know, now maybe we should sell our house. We can get a really good price for it. We can move into our dream house and we can get a decent mortgage. Not a great mortgage, but a decent mortgage rate. So I think you're gonna start seeing that open up. But is it gonna be enough? Well, that's really gonna depend on unemployment numbers, because if you don't have a job, you're probably not gonna be able to get a mortgage. So as long as the jobs hold, well, then that might be interesting, which will be very interesting for real estate, because real estate's been on an up and up until recently, where it's softened a little, but these rate decreases might just spur more price appreciation in real estate. So if you got some real estate and you're wondering, should I sell now or should I wait? Well, I don't know what the answer is, but I will tell you, now probably would be a really good time. Even if the Fed continues to decrease rates, it's only going to decrease rates because, well, let's roll the clock back. Remember that article I started with, 2007? What happened after the Fed dropped rates 0.5%? Well, that was 2007, and I think you all know in 2008 was a doozy of a recession. So, are we on that same trajectory? And if we are, what do you think the price of your house will be when we're in a recession? Will it be more or less? I'm waiting. More or less? Well, while we're waiting, why don't we do this? Why don't you all just take a second and click this little subscribe button, hook a brother up, help me out. Give me some more subscriptions. I put content out every single day, so click the subscribe button. And also, while you're at it, there's a little bell. Smash that bell so that you're notified every single time a new piece of content comes out. And we do lives all the time. So with that being said, let's get back into this. So let's look back. Here's an article from Yahoo Finance. Now, it says that Fed has lowered interest rates 28 times so far this century. But let's just look at what's happened every time they reduced them. I remember this one, 2001. Yes, that's right, the dot-com crash. They started reducing rates and they did 11 rate cuts. And at first, they were due to the US recession. But after that, the dot-com bubble burst. The terrorist attacks of September 11th came into play, and that was 2001. That was another catalyst and drove the Fed to drop rates. So when we look at the Fed dropping rates, what happened? Well, they say the recession ended in November of 2001, but the recovery, well, what recovery, right? That recession carried on for 3 years. I remember that because that's what forced me into Wall Street. I needed a job. My retail stores just weren't able to support me during that period of time, which means the S&P 500 didn't respond immediately as well. But let's just keep going further because that's not the only one. 4 years went by and no changes happened to interest rates in that point until the one I've been talking about this whole time, 2007. In 2007, the second half in September, the Fed cut rates. And that, yes, drove the market higher, but after that, it led to the recession. Are we on that same trajectory? I don't know. But right here, you can see what happened in the past. The US economy was in a decline so bad that it became known as the Great Recession. The Fed cut rates by 0.5% twice in October, followed by a 1% cut in December, and the S&P initially plunged, but it bounced back beginning March of 2009. But any of you remember that? You probably don't remember when the market started coming back because it was such a severe crash that that's all you remember. You literally have it permanently seared in your mind how bad that was. All right, so then more than a decade went by. The US economy and the stock market roared back, and we went into the longest bull run in history until August of 2019. Now, remember, 2019 wasn't when COVID happened. I want to preface, 2019, a lot of people are like, oh, that's when the pandemic started. Oh, no, no, no. The pandemic started in 2020, but in 2019, the Fed and Powell began what they called a mid-cycle adjustment, and they reduced rates by 0.25%. But they did that 3 times. And the last cut was October 31st, 2019. You could see it right here. The initial cut didn't seem to cause any stock market reaction, very similar to what just happened with this rate cut. It was mood point at best, but we're sitting at all-time highs now. So back then, it didn't really have any effect. However, the S&P 500 took off straight up after the Fed's October move. Look at that chart. Holy crap. But then, darn it, we had a little situation called COVID-19. Yep, the pandemic, yep, and it shut the whole world down. And then what did the Fed do? Well, the Fed started cutting rates, and they didn't stop. They cut them all the way to 0, and they even talked about going negative with those rates. And did that make an impact? Nope. You all remember the pandemic. That was rough. That was rough. But then after that, what happened? Well, $5.2 trillion, I think it was actually more than that, but we'll just call it $5.2 trillion of money was printed, thrown into the markets, along with historically low interest rates. What happened? Yep, you know it, the market went up, straight up to where we're at today, sitting at all-time highs. The Fed just dropped rates 0.5%. What's next, folks? Boy, oh boy, history is quite a predictor of the future, isn't it? Are you drawing a conclusion here? If you're not, you are focused on all the wrong things, and that is probably focused on greed. You're like, no, 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 the Fed's always going to step in and save the markets. What if the Fed can't save the markets? You see, after this election in November, I will tell you what's going to happen. It doesn't matter who gets in. One might be slightly better than the other, but let's just forget about it. They're both going to have the same outcome. After they get elected, the markets will start to waver. The economy will continue to spin and spiral downward. The markets will fall apart just like they did in the past. You see, here's the thing a lot of folks are not focused on. Why is the Fed dropping rates 0.5%? If everything's okay, if the markets are on track, if we're going to soft land, if the whole economy is doing great, says Kamala Harris, everything's fine. Everything's good. The Fed just thought, hey, maybe we'll just throw a bone to everybody and we'll just allow the corporate greed to continue and let them make some more profits on these rate decreases. Because when the Fed drops rates, it makes it cheaper for corporations, i.e. Wall Street firms, to make more money because they can borrow cheaper. And also, it will help some of you. You get cheaper mortgages, cheaper car loans. Oh, and the cost of cars has come down about 1%. Okay, not much, but a little bit. We're moving in the right direction. So all is good, right? Well, keep believing that fairy tale. All is not good and all will not be good in the future. But depends on who you're listening to, what news station you watch. See, I don't really like to watch any news stations because they all piss me off, but I do love history. And history always sends us down the right path because history repeats itself. So, are you ready? Are you ready for what's about to happen? Well, let's just take a deep dive into what some of my peers are saying. So what we did is we went into the video archives right here on YouTube. So I want to give a shout out to everybody that we took some pieces from, none other than the famous Graham Stephan. Okay, we got Andre Giek, we got Patrick Bet David, you probably have seen him, and you got Eurodollar. These are all YouTube channels that maybe you're following already, and if you are, awesome, but make sure you're subscribing to this channel as well. So let's just hit some of the common points, and I want to focus on the common points that each of these folks are hitting on. Federal Reserve rate cuts. So right here, if we look at the decision they just made to cut it, each one of these individuals has a little different take on this, but each of them are saying that this is signaling a shift from aggressive rate hikes to combat inflation, as you know, but also this cut is seen as a response to cooling inflation and slowing economic activity, i.e. jobs, okay? The key focus in all of their discussions from Patrick Bet David, the Eurodollar University, Andre Giek, and Graham Stephan is things may not be as they seem. Moving on to inflation and the economic response, inflation has significantly dropped from its peak of around 9 to about 2.5, okay? This all aligns with the Fed's 2% target, and this is what Graham Stephan is talking about. And he says, all of the discussion about how inflation is cooling off allows the Fed to start cutting rates, but how is that going to impact the economy in terms of consumer pricing, which is already out of control, housing and housing pricing, which is way, way up, and stock market performance, which the stock market is right now at all-time highs on the day that we are recording this video. So let's just look at some commonalities in terms of all of these individuals on the impact it will have on the stock market. So, well, here's the one thing. All of those individuals agree that rate cuts often have a positive effect on the stock market. You can see that by looking at the stock market today. But they all throw caution to the wind because although rate cuts typically will stimulate growth in the stock market, it can be short-lived. Just like they did in 2007, they stimulated growth until they didn't anymore, just like they did in the early 2000s, just like they did in the pandemic or right before the pandemic. So all of them are saying, be cautious, because there are still recession risks and high recession risks. Contrary to what Yellen and some of the other pundits will sit there and say, oh, we're gonna soft land. No, I don't think we are, because there are way too many economic uncertainties in the markets today and in the economy today. I mean, have any of you looked at what it costs to buy food? How about fuel? How about housing costs, which are all up? You see, all of these things are recession risks, all of them. Okay, and none of these problems have really been fixed. And lower rates won't fix a lot of these problems, especially the biggest problem, which is debt. I know lower interest rates will help ease some of the pressure on these debts, but it won't make it go away. And a matter of fact, most people are living above their means right now, which all points to one place, and that is economic slowdown. Because as these debt limits climb, so do the payments on these debts. And as interest rates soften, that's not going to be fast enough of an impact on these debts to save the day, although the Fed thinks it will be. So that brings me to another thing that every one of these individuals said: debt and economic concerns. So we summarized what all of them said. So let me just read this. Debt is a recurring concern across all discussions, whether it's corporate debt, consumer credit card debt, or government debt, which I hadn't mentioned yet. You see that the government's got a little bit of debt? Yeah, just a wee little bit. There's a shared understanding that the US is facing a serious debt crisis, and it could worsen with rising interest rates, potentially leading to a higher interest payment for the government and a slowdown in consumer spending. Consumer spending's already slowing down. You're seeing it in the outlooks of all the companies that are reporting earnings, with the exception of a couple. But not only that, we all know that the Fed and the government, they got a little thing going on with some debts. The Fed holds a lot of US debt on their balance sheet, but they've been unwinding that. And the US government has gotten to a point where the interest payments on that debt are literally, I think it's like $1 trillion a month or something like that. So a rate decrease certainly will help ease a little bit of that. 2 rate decreases in 2024 will definitely help ease that, but it's a spending problem. And the government has a little bit of a problem with spending. You see, they make more, they spend more. They make more, they spend more, and when they make more and spend more, the Fed just prints more. And when the Fed prints more, that's inflationary. It creates a little bit of an issue because your dollars become worth less. Anyway, let's get back on topic. I already talked a little bit about real estate, but let's just look at what all these individuals said about the housing market and mortgage rates. Okay, all point to the housing market being in a tough spot, as I alluded. While rate cuts can reduce mortgage rates, many homeowners locked in low rates are reluctant to sell and still will be reluctant to sell because rates haven't come down that much, which is leading to a housing market slowdown. Housing affordability and mortgage rates remain the central issues, and the general consensus among all of them is that it will take significant rate reductions to truly re-energize the housing market. Significant rate reductions. Not 0.5%, not a full percent, significant. Will the Fed go that extra step? Will the Fed reduce rates enough to really re-energize the housing? Well, the answer would be yes, but only if we are entering a recession. See how this works? Yeah. Remember I said what happened in 2007? How about during the pandemic? How about in the early 2000s? Shall we go back even further? Because it's the same story every single time. But yet we all have short-term memories. And we all only see what's happening right now, and very few of us actually go back in history like we did to show you this isn't the first time this has happened. This has actually happened over and over and over again, and the outcome? Well, it's almost always the same. Yeah. You know what that outcome is? Well, let's just talk a little bit about one of the other reasons that outcome will most certainly happen this time, and all of them agree to this, and that is unemployment and labor markets. So, let's talk about unemployment a little bit. I think you've been watching the news and maybe you've been paying attention to the job numbers being revisited to the tune of, I think that one revisit was like 800,000. Whoops, we messed up on 800,000. No big deal, nobody's paying attention, but they all were paying attention the first time. So discussions about unemployment highlight that the labor market is still relatively strong, but could weaken with the further economic slowdown. And this is an area where Patrick Bet-David loves to talk about it, but also Graham Stephan mentions this. Both talk about the jobs market softening due to recent interest rate hikes, while Eurodollar University emphasized that the global weakening of the labor markets as central banks continue their rate cut cycles. Now, I know we pay attention to just the US rate cuts in the US markets, but have you been paying attention to what's going on in Europe? How about Japan? Yeah, Japan gave us a little bit of a scare. What about all the other countries? You've been paying attention? Yeah, well, it's very similar to what's happening here. Some are a little further ahead, some are a little further behind where we're at here in the States, but you know what? The Eurodollar University is looking at this as a global weakening of the labor markets. And wrap it all up with a pretty little bow tie. Let's talk about recession risks. A potential recession is the major theme among all of them, including myself. I've talked about this a lot, with all sources suggesting that the recession could follow the rate cuts. Why? Because it hasn't passed. With timelines ranging from next year, August 2024, and sometime before 2026. So every one of these individuals is saying, well, right now, all the way to 2026, which really in the grand scheme of things, once we're through this recession, not that much time. So I hope you're preparing, because all of them are saying that the recession risk tempers the optimism. Let me repeat that. Recession risk tempers the optimism that usually accompanies rate cuts. In other words, everybody's a little bit scared of the recession that's probably going to happen. Yeah. Oh, but when? When, right? Everybody wants to know when. Well, you can't time the market, so my answer is, I don't know, somewhere in that range that I just gave you. But you know what? They decided to go a little bit further. So Patrick Bet-David says more precisely in predicting a recession by August 2024. That's what he had said. Now we're past August 2024, so he missed it a little bit, but he's probably not too far off. Because, let me kind of go off topic here. One of the things I covered not long ago is I covered how the inverted yield curve, a great predictor of recessions, uninverted. Literally, it's where it pops out and becomes normal again. Well, every time that has happened in the past has resulted in a recession very soon after. So Patrick Bet-David was probably looking at the same thing as that, and he was saying, well, we're probably right on the cusp of a recession. Now, I've talked to a whole bunch of people, and they're like, wait a second, I thought we were in a recession. Well, Yeah, but not technically. Eurodollar University focuses more on the global economic slowdown and mentions how recession risks are tied to corporate and labor market weaknesses. Whoa. Corporate and labor market weaknesses, both of which we've seen slowdowns in. Got it. Then Andre Geic mentions a 56% chance of a recession before 2026. I have no idea where he came up with 56%. He might have just been like, well, that's a cool number. 56% sounds good. Or he pulled that from somewhere else and also reflected a longer term outlook on that, while Graham Stephan suggested that the risks are present, but he doesn't comment on a specific timeline because Graham, like myself, would say you can't time the markets. But we can all agree to disagree that a recession is imminent. Stock market outlooks. This is another thing. Andre Geic and Graham Stephan point out the potential for stock market gains. And they're always very optimistic on the stock market, unlike me, that I'm telling you, get out while there's still chance of taking a profit. But they're optimistic, but they're much younger than I am, and they're much younger than Patrick Bet-David. So they're saying that following a rate cut backed by historical data showing that the stock market increases in most cases after a rate cut. True statement, but for how long? That's the most important thing you have to look at. However, they both caution that you need to be skeptical, and they focus on the possibility of market stagnation or a downturn given high levels of corporate debt and inflation concerns. Housing market reactions. Okay, well, we already talked about the housing market, but right here, while all discuss the housing market, Patrick Bet-David emphasizes that the housing market stagnation caused by people not wanting to sell their houses at higher rates, leading to historically low sales. You're already seeing that. So he's probably dead on the money. But Graham Stephan is more optimistic about potential rate cuts and how they're going to impact, because he says that 1% reduction in mortgage rates, which is what they're anticipating for 2024, could open up a market of millions of buyers. And well, some of you would probably be upset if I didn't cover Bitcoin, so let me just hit this one real quick. Bitcoin and cryptocurrencies, which Andre Geic and Graham Stephan both touch on Bitcoin and cryptocurrencies as a beneficiary of rate cuts. I would sit there and say that Bitcoin is definitely correlated to the stock market. So whether the stock market's going up or down, so there is Bitcoin and all the cryptocurrencies are doing the same. But they make a good point, and Andre Geic being particularly bullish on Bitcoin's long-term prospects. Patrick Bet-David and Eurodollar University don't dive into crypto, but they talk more about just basic traditional markets, debt, and inflation. But there was another article that we pulled up all about crypto, and what it's basically saying is both of these presidential candidates are pro-Bitcoin. Well, let me preface that. Trump is pro-Bitcoin, saying he's going to make the US the leader in Bitcoin and cryptocurrencies, when Kamala, well, I don't really know her standpoint, but I do know they're accepting donations in Bitcoin. So if you want to donate to their campaign, they do accept Bitcoin donations. I don't know if that means they're pro-Bitcoin or if they just want your freaking money. Either way, I don't know. So I think it's fair to say both of the candidates are, at this point, pro-crypto. We'll see what shakes out after the election. But the final thing I want to talk about is the global versus US centric focus. So Eurodollar University takes a really good approach because they look at it from a global perspective. And what they're discussing is the role of the central banks. For example, Swiss National Bank, ECB, Bank of Canada, etc. And they look at how does cutting rates combat economic weakness. So Patrick Bet-David, Andre Geic, and Graham Stephan all focus on a more US-centric view of the economy and its direct implications for American consumers and American investors, which is kind of where I sit. To wrap this thing up with a pretty little bow and put this to an end, I think you can see what's going on here. If we look at the history, if we look at the past, we can really derive to a conclusion that where we're headed is the same place we've always headed when this situation has happened. We've got global weakening. We've got jobless numbers starting to kind of show the weakening. You've got all the signs, including now the telltale sign, which is the Fed aggressively cutting rates. Yes, in the short run, it'll probably be a good thing for all of you stock investors. Take your gains, love them. They're not going to probably last, because then after that, I would say after the election, you're going to see all of this come to a stop. You're gonna see the markets start to capitulate. You're gonna see the markets start to go down. I don't see any way for the markets to push higher unless the Fed turned on the printing press again, which would be completely irresponsible and probably met with incredible skepticism across all levels. So folks, when you're looking at this whole thing, I think it's best just to look at history as your guiding light. It's best to take the torch and raise it high and be the light in the darkness and tell people the truth. And I know the truth hurts, but the truth that you probably are not going to see the markets push higher and higher and higher. More likely to see the markets go down. And that's going to hurt a lot of people. That's going to soften the economy. That's going to soften everybody's pocketbook. And that is what you should be preparing for. Because the one thing I will tell you is, unlike any other time, right now, you're paid to sit on the sidelines, at least today. With that being said, folks, I hope you've enjoyed this video. My name's Chris Naugle. This is What Now? What's next for the Fed move? And I got this other video that I created I think you're really gonna love. If you like this one, check this video out right here. A look from 2025. See you on the next one.